Welcome to 3 and 3. Today we're going to be talking about the Magnificent Seven, the H.O.P.E framework, and employment. So the Magnificent Seven are some of the top performing stocks in the S&P in 2023. That includes Meta, Apple, Amazon, Google, Microsoft, Tesla, and NVIDIA. These stocks now make up about 30% of the S&P 500 index and almost all of the returns year to date. Big tech has definitely rallied this year due to the rise of AI and the expectation that the Fed will start cutting interest rates sometime in the near future. It resembles somewhat of the Nifty 50 back in the 1960s and 70s, where the market was infatuated with about 50 large cap stocks, and they gained immense popularity and returns during that time period. So what you're looking at here is a chart going into, again, 2023 and up to June of 23. And you're comparing the 7 magnificent stocks year-to-date returns of 53% against the S&P 500 index and also the remaining 493 companies. And you can see the dramatic outperformance of those 7 stocks. Now, looking at the S&P 500 index in historical terms and comparing it to the Nifty 50 back in the 60s and 70s, you can see that dramatic outperformance. And those 50 stocks represented a large allocation of the index by the time 1972 ended. And when the economy finally hit a recession in 73, 74, you can see the underperformance of those stocks in relation to the S&P. So the H.O.P.E framework. So H.O.P.E gives a roadmap for how the economy responds to changes in interest rates. So the H stands for housing. And it's the first to slow and serves as a great leading indicator. If you look at the March of 2022 peak at housing, that was the first start of where interest rates started to rise and housing started to slow. Orders is the second to slow and tracked with the ISM. That index has slowed into 2022 for sure, and also now in 23. Profits. So it's the third to slow and tracked as companies report earnings. We've been in a profit recession now since the fourth quarter of 2022. And the last is employment, and is usually the most lagging part of the economy. As you can see this framework from this chart, what again transpires is the first reaction, and we start to move slowly through the actual cycle. And that correlates to, again, the economic clock, which typically registers this slowdown of actually the economy and eventually employment as we move further along. We're expecting most likely that scenario to occur in late 23 or early 24 as companies actually start to realize that their profits haven't really picked up and inflation is eating into their margins. So employment, this is the last again to slow and usually the most lagging indicator. The labor market in the US currently remains very resilient. In the June 2023 jobs report, we had 209,000 jobs were added and the unemployment rate dropped to 3.6%. As you can see in this chart, going back to previous recessions in the 70s, you can see the lag there. The gray bar is actually the recession, and not really until we start to see the recession hit is where employment losses start to occur. The 74 recession, the 82 recession, and again, the Great Recession, where we saw that dramatic rise in unemployment. We're not expecting anything of that magnitude, but we are expecting a pickup in unemployment in 2024. Thank you for joining us for 3 and 3.